David Page, the US trade policy under President Trump is creating a lot of uncertainty. What do you see as the most likely outcome?
Well, I think we're looking at a couple of scenarios. The most likely outcome, we think, is that we do see this 200 billion of Chinese imports being covered by exports, initially at 10%. We think there is a risk that that rises to 25%, as has been promised by the president as we go into 2019. But we're hopeful that after that period, importantly after the midterm elections, that we see an easing in the policy, perhaps some negotiations between China that stop, at least in the short term, escalation beyond this 200 billion. Now, we don't think the problem is going to go away. We think that US-China tensions will remain, and we think there's a risk, particularly depending on how the midterms go, that as we move into 2020, we might see President Trump engaging in more trade policy. But for now, as I say, we're hoping that after we've gone through this 200 billion and it gets ratcheted up to 25% in January, we get a pause for some time.
So does that mean it doesn't affect the US economy too badly, or how should we, what do we think about this?
So I think there's two things. I mean, the direct impact on US GDP growth is likely to be relatively small from this 200 billion per se. Our estimate suggests that you'd probably have to shave off about 0.1 percentage points worth of growth off of next year's, and then 0.1 off of 2020 as well. So it does have some impact, but it's not massive. There's not a big impact coming through on inflation either. But I think the other factor is obviously going to be the sentiment factor in financial markets. We've seen financial markets react to this. And I think particularly as we go into the midterms, it's likely that trade policy and fears of escalation beyond 200 billion mount. So there could be some impact that comes through on stocks in the sort of next couple of months. And that's possibly going to be even more than the actual economic impact. Then as we look a little bit further ahead, clearly we're trying to determine just how far this policy eventually goes. But as you say, in terms of the overall 200 billion, if it stays at that, the macroeconomic impact of that is relatively slight for the US at least.
You mentioned the financial markets that might react in the future, but now we see new record highs. So I don't know, are they thinking, oh, it's going to be no problem, or why do they not fear about this?
So I think there's a couple of things. I mean, firstly, the US economy fundamentally is doing very well. We saw very strong expansion in the second quarter. It was up 4.2%. We still think we're going to see significantly above trend growth in the third quarter as well. So the momentum of the US economy is doing well, and of course that's driving profitability from US corporates. Earnings are doing well, and that's fundamentally underpinning the equity market. But the other factor is, of course, that when we see the implementation of these tariffs, a month ago, we were being told that there would be tariffs of 25% on 200 billion of Chinese exports. And now we're seeing that it's 10%. And so that provides markets, A, with a little bit of relief, and B, with some hope that there's a little bit of negotiating scope there. So for the first time, I think markets are perhaps wondering whether or not the US is taking more of a negotiating position. And that probably adds to a little bit as well. But I think fundamentally, it's a story of US economic strength for now.
You already mentioned the midterm elections in the US, so how important are they for the future of what's going to happen in trade war and all the policies?
Well, I think they have some influence. I mean, you know, they're nowhere near as important, for example, as the presidential election itself 2 years ago. That was a real game changer for the economy, and we see this as much more minor in its impact, but it could still have some effect. Our estimates based on polling at the moment suggest that what we're likely to see is the Democrats take control of the House, but the Senate remain in Republican hands. So you have a split Congress, but one that's not fully supportive of the president. And that's likely to see some blockage in legislation coming through. So specifically, we think Republican plans to instigate another phase of fiscal stimulus probably come to nothing. Republican plans to reduce Obamacare probably come to nothing as well. So we get a bit of political logjam. That doesn't really have too much impact on the economy. Perhaps the dollar dips a little bit, or to put it another way, if Republicans got through stimulus, you might see some more upside. But I think the risk case, particularly for trade scenario, is that if the president is unable to pass legislation through Congress, then instead he might it might give him more impetus to move back to trade policy, which he does by executive order. And that trade policy, he still thinks, talks to his political base. And that's why we think there's a decent risk that although we see a hiatus, a pause after this 200 billion, ultimately as we move towards the presidential elections, we could move back in that direction.
Another important topic, especially here in London, is of course the Brexit. We have the Brexit deadline. It's just 6 months away. What do you think is going to happen in the UK then?
Well, I mean, obviously at the moment, and particularly in the light of the Salzburg summit that we've just seen, there's significant uncertainty as to whether or not a deal can be done with the EU, whether or not Theresa May would be able to sell a deal, what shape that deal would ultimately take. And I think one of the few things that we're pretty positive, or we hold high conviction on over the path of the next few months, is that we're very unlikely, we think, to see this smoothly wrapped up in the next couple of months. So there had been some talk pre-Salzburg of a November summit, and the deal being sort of gift wrapped at that stage. We think that's highly unlikely. And so as a deal fails to materialise in November, as it carries on towards Christmas, probably into the new year, I think the market probability of not eventually getting a deal is going to rise quite markedly, and that's going to put UK's assets under a lot of pressure, put sterling under some pressure. But ultimately, we think that certainly the UK nor the EU has any incentive in seeing the UK crash out of the EU without any deal in March. So we think that the worst case scenarios are unlikely to come about. We ultimately think that a deal can be managed to be cobbled together, and that Theresa May will be able to wrap domestic politics in behind her to support that deal. So on balance, we still see the UK achieving a deal and moving into transition, which would be a relatively good outcome. You know, the outcome compared to the UK staying in the EU over a long period of time is still likely to be negative for the UK economy, but getting transition and a deal with the EU would be immeasurably better than leaving the EU in March with no deal in place.